Hey guys, it's Sasha. During a market crash like the one we're in right now, you will hear a lot of people telling you that you can make a lot of money by perfectly timing the market, selling out at exactly the right moment and then buying back in when the stocks have gone down. One YouTuber after another will be telling you that they know when the bottom was going to be. You should not invest because only idiots will invest when the whole market is going down. You are just going to catch a falling knife. It is much better to wait and then invest at the very bottom, and you will make a huge amount of money as a result. The big problem with this theory is that it is complete rubbish. And unlike the proponents of drawing random lines on charts, pretending that those random lines mean anything whatsoever, I actually have data that I'm going to share with you. Numbers do not lie, and let me show you why dollar cost averaging through the downturn absolutely destroys timing the market over the long term. It is not even close. First, let's talk about investing during an actual market crash. I will show you how much money you can lose trying to time the market when the market doesn't end up crashing a little bit later. So let's use a popular recent example of the dot-com bubble. Let's assume that you are an investor in your 20s or 30s, and let's say you started investing a few years ago and you have, say, $20,000 in your portfolio. And let's say you are financially astute and you are able to put $1,000 per month into your investing account every single month. This is just an example. I know everyone's personal numbers and circumstances are going to be different. So let's say you are looking at this person in August 2000, just before the stock market began collapsing. And then let's say that person just goes and puts in their $1,000 into the stock market every single month, come rain or shine, and they just buy the S&P 500 because they are boring and ridiculously sensible. They invest in September 2000, in October 2000, in November 2000. They don't care if the market is going up, going down, going sideways, whatever. They just keep putting money in every single month. And let's look at the 4-year window through to July 2004 that roughly covers the crash and then the initial bit of the recovery. If you kept feeding your money in every single month over that period, you would have invested $68,000 during that time frame, including the original $20,000 that you already had. And if you were buying the S&P 500 index with your money once a month using the numbers from this chart, assuming that the original $20,000 bought at the very peak, you would have 35.5 units of the S&P 500 index at the end. These would be worth $60,352 because in July 2004, you were still at a much lower point than when you started, so you would be down $7,600 on your investments because of the market crash. So about 11% down after the biggest stock market crash in living memory. And then let's say that instead of being dumb and just investing every single month, you listen to a financial oracle, some kind of god, some kind of prophet who knows everything and exactly what's going to happen, and they tell you that you should time the market. So the markets start falling, and in the first couple of months, all of these financial oracles will usually be telling you to buy the dip. You know, it's just normal fluctuations, the market goes up and down, you gotta buy the dip. Look, the market dipped in November, but then stayed flat in December, and then even had a little bounce in January. Maybe that was just a wobble, but then it goes and starts diving down in February, and you time it absolutely perfectly, and you go and sell as soon as that begins happening, going into March 2001. Then you wait out the big drop in the summer of 2001, and then you wait through and do not invest even during the biggest drop during the summer of 2002, and in the summer of 2003, you're still not quite sure. Is the market going down even more? Is there another dead cat bounce happening like the one that we've had in November? But by December 2003, the market has gone up again, and you decide, okay, now it is on the way back up. You decide to buy back in. And you're an investing god because you just bought back in at 15 to 20% lower than the point at which you sold. Well, if you did that, if you took all of the money that you had when you sold, plus then added the additional $1,000 per month that you would have invested had you been doing it every single month, then you used all of that money to buy back in at that point when it begins going back up, you would have had 35.1 units of the S&P 500, and those units will be worth $59,682, which is about $700 less than if you did the dollar cost averaging. But you know what? It actually gets massively worse from here, because when you sell stock, you also have to pay taxes and fees. Now, fees will probably affect most people, but let's give you the benefit of the doubt. Maybe you live in the United States, and maybe you use a platform like Robinhood where you're not paying any fees whatsoever. So let's just assume here that there are no fees involved. By the way, if there are fees, this problem just gets much worse for anyone trying to time the market. But you'll still have to pay taxes. So let's assume that you were a great investor before the market crash started, and that $20,000 that you had in there included, let's say, 50% in capital gains. So $6,700 out of that 20 would be your capital gains, and in most countries you will owe something like 20% on long-term capital gains, so you will have to pay $1,333 in capital gains tax when you go and sell that position. Obviously, there is no capital gains tax on the $1,000 that you invested in the first few months of the crash every single month, because the value of that went down. So actually, when you sold out to time the market, you had to pay tax, so the total you collected was lower by $1,333. And I know that there are tax-advantaged accounts in some countries that allow you to invest a few $100s a month or whatever it is. I'm just using the average across all the different kinds of people in all the different kinds of countries. And if you then do the maths, and you went and timed the market really, really well, if you do have to pay that tax, you would only have 34.3 units of the S&P 500, which would be worth $58,400. So you would be 3.2% down compared to just dollar cost averaging in. Now, I am sure somebody is going to be really smart and point out that because you already paid the capital gains tax, you will not have to pay that capital gains tax on those gains in the future. So you saved a bit of money there, and yeah, that's kind of true, but the amount you saved on not having to pay that tax in the future is actually lower than the amount that you lost in total by trying to time the market. In this example, you have saved $1,300-ish on tax, but lost $2,000 on timing the market. And the problem is that this tax issue multiplies in a really nasty way. If you have to pay capital gains tax every time that you do this timing the market, you'll be reducing the total pool of capital that you have invested over and over and over. And doing that many, many times over a long period of time is much, much, much worse than paying one lot of capital gains tax at the end in terms of how much net you have left at the end of your investing career. When you multiply those reductions down, you can easily be losing absolutely giant chunks of your investing portfolio without realizing it. But here is the worst bit. Let's say that you are Nostradamus. You are the perfect investing god. And instead of the rubbish example that I showed you, you time the market to perfection. So you sell in the very first month that the market dips, in November 2000. Right away what's happening, is going all the way down by 50+%, and you decide to go and sell out. And then you wait. And you buy back in, not at some point, when the market's been going up for a while. No, you buy back in the first month when the market decides to go back up, in May 2003. If you do that, using the same exact calculation, you will have 39.2 units of the S&P 500, which would be worth $66,674. So if you time the market absolutely bang on perfectly, like an absolute champ, you will be 10% up compared to just dollar cost averaging all the way through. 10%, that's it. If some of the positions that you sell are short-term capital gains instead of long-term capital gains because you only bought them within the last 12 months, you would be taxed at about 40%, roughly give or take, instead of the 20%, so that gain will be considerably lower. So the maximum gain that you could have had in this period over dollar cost averaging, if you timed it absolutely brilliantly, is 10%. And the much more likely outcome given that you probably won't get it absolutely perfectly bang on at the top and the bottom, is that you are going to lose a lot of money if you get your timing wrong. But not every crash is the dot-com crash. The 2008 financial crisis was much sharper on the way down and then on the way back up, so the chances of you hitting the top and bottom or anywhere close to them in that particular crash were pretty much zero. And if you followed the same exact approach, for example, back in March 2020, when COVID arrived, and you sold in the first month of the market going down before realizing 2 months later that that you got it horribly wrong, you would have lost around 20% of your portfolio right there and then just because you were a plonker. Because you see, the market drops by 5 or 10% quite frequently, and if you go and sell out each time that the market does it, you'll be paying out capital gains tax each and every time, and most times the market will just go and bounce back up and you'll be left holding your private parts in your hand as you've lost 10 or 20% of your total portfolio every single time that the market doesn't end up crashing all the way down. That tends to be roughly 4 to 5 false drops for every one major crash. They all look just as bad as the beginning, so if you were to go and try to sell the moment the market starts going down in each one of those, and you realize that you screwed up fast, you might only lose, say, 10% each time. And if you did that, you would be 40% down during those fake crashes before the real one even turns up. And when the real market crash does turn up, the likelihood is that you will still lose money during that crash versus dollar cost averaging on top of already losing half of your portfolio before you even got there. As your portfolio grows over time, this problem only gets worse. If you sell a large amount relative to how much you're contributing every single month, then the capital gains liability on that large amount will be very big compared to your monthly deposits. So you will be absolutely killing your portfolio in the process. And if you sell out a large amount and the market does not crash, and you lose that 10 or 20% of your total because you buy back in after the market bounces back up, that will be several years of your investing contributions wiped out in just a month or two. So if you are thinking of timing the market, you might be able to get it right. And maybe you will make a few percent as a result, and you will be extremely ecstatic about achieving it. But on average, over the long term, the overwhelming mathematical likelihood is that you are going to lose a huge amount of money instead. So just keep that at the forefront of your mind next time that you're thinking of timing the market, or next time you're listening to somebody who is telling you that you should absolutely do it. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it. And as always, I'll see you guys later.